Moving on to our next topic, we want to talk about ETFs, fixed income ETFs to be more precise, and how they can optimize portfolios. That's our next topic. And I'm delighted to introduce our next speakers, Dan Aronson, who is a ETP client product specialist, and John Kerschner, our head of US Securitised Products. Dan and John, over to you.
Great. Thanks, Sarah, for the introduction, and good morning, everyone. As Sarah mentioned, I lead our ETF distribution efforts, and John Kerschner heads up our securitized product and is PM on several of our ETF strategies. And we're excited to talk fixed income this morning because after a brutal 22, there's actually yield again. With the higher yield, however, comes a good amount of uncertainty that we continue to hear from advisors around how to allocate within fixed income. A couple of themes that we still see from advisors in their client portfolios today, focusing on higher quality, shorter duration. There have been countless times over the last several months where I've spoken to advisors that told me they've bought US Treasuries for the first time in their lives. And we continue to see industry flows into money market funds as well. So as the Fed is getting potentially closer to the end of tightening, we continue to hear the question around when should we materially extend duration, although we are starting to see some allocators getting a little bit more comfort in that direction as we've moved through 2023. On the implementation side, we've continued to see interest in our active fixed income ETF franchise, which really is focusing on higher credit quality and providing a pretty meaningful pickup versus US Treasuries and money market funds. And just taking a quick step back, as we've built out the ETF capabilities over the last 7 years, we've been really focusing on doing so slowly and methodically, really looking to marry where we see opportunities within the ETF landscape to provide a differentiated exposure and marrying that with the in-house expertise here at Janus Henderson. And in particular, what we've seen from our securitized exposures, which again, John helps us run, we saw solid 2022 inflows despite a really challenging backdrop. And as we've moved into 2023, over $1 billion of net inflows into our products. First and foremost, though, really educating the advisor and broad investor community is of paramount of importance to us, and really with a focus on 3 key areas. First, the ETF wrapper itself, and especially now that active fixed income ETFs have really started garnering attention in assets, really understanding the liquidity, the trading around it. We bring our capital markets team into a lot of client discussions, talking about the true liquidity of an ETF versus the screen volume, talking about bid-offer spreads, as well as the create-redeem process. Second, securitized credit is still generally less widely known or understood within the advisor community. And I think John and the team do a great job of consistently putting out white papers and thought pieces on those sectors. And we do put those on our website for the ETF product pages for the public viewing. And we really do view this space as a core building block for fixed income portfolios. And then the last piece of the pie, how do these strategies integrate within portfolios more broadly? And so we've built out here over the last several years our PCS team, Portfolio Construction Services, which is really a construction on the portfolio side and diagnostic tool for advisors to run their models through. And then we set up one-on-one consultations with our portfolio strategists. And a lot of times this focuses on risks the advisor may not fully appreciate or really be aware of, thinking about style drift of the underlying manager, for instance, and really focusing on opportunities in areas that they may not currently be allocating. And then the last thing, because we've done about 15,000 of these reviews over the last few years, we provide the allocator a sense of how do their models and their portfolios stack up versus their peers. And so while all this broad engagement and education is good, it really is that one-on-one interaction with the client that remains critical. And to that end, we certainly welcome any questions from you, the audience, at the end of this discussion. So now, John, let me turn over to you. And maybe if we can start a little more broadly, and given your 30+ years of experience in fixed income, maybe talk about the evolution of how allocators historically would look at fixed income in terms of implementation within a portfolio, and kind of what we're seeing, given the proliferation of offerings at their disposal today.
Yeah, thanks, Dan. And let me thank everybody joining today. I think this is the last session, so we're going to try to make it pretty energetic, give you a little history lesson, and then talk about what's going on today, and then also talk about what we think is coming in the future. So starting with, asset allocation, I want to take you back almost 30 years to kind of the mid-90s when I started my career. These are post kind of the Wild West days of Liar's Poker, Michael Lewis's famous book, and when money management really moved into the modern age. And what was happening back then was that all big asset allocators would go out and try to find the best money managers in a particular asset class. So I worked for a firm that was a mortgage expert. So asset allocators, which was pension funds or RIAs, would come to us and say, we need some mortgage exposure. What can you do for us? And we'd present to them. But that was our box and pretty much where we spent all our time. There were experts at corporate credit, either IG or high yield. There were emerging market experts. There were municipal experts. There were rate experts, macro experts. And so these asset allocators would probably go out and hire 3 or 4 in each of these boxes. The problem was they'd end up with 50 different managers, plus or minus, and they would spend all their time doing due diligence on those managers. And obviously, if you think you have that many managers, it's going to take up a lot of your time. So there were then the next evolution, and this kind of came about late 90s, early 2000s. Some of the big money managers said, look, you don't need 50 managers. Just come to us. We have great mortgage people, great credit people, great rates people, great macro people, and just buy a core or core plus strategy benchmarked to the ag index. And then you can do a hub and spoke model where you have your core. And then if you want more mortgage or more credit, you could add on to that. And that worked very, very well for a very long time. And why was that? Because the ag was actually yielding somewhere between 4 to 7%. The duration was between 4 to 5 years. But most importantly, real rates average between 2 and 4%. And actually, if you take the straight average during that time, I'm talking mid-90s to the GFC in 2008, it was about 2.85% real rate. So that's taking out inflation. That is a very high real rate. And it was really the glory days of fixed income investing. We didn't really know it now, but didn't know it back then. But the ag worked. That's why 60-40, 60% stocks, 40% bonds worked. And it was just really the halcyon days. So now, let's fast forward to today, because that's obviously not the case today. And even with yields up over the last year, the ag still only yields about 4.5% versus 15 years ago where it was about 5.5%. So you're getting 100 basis points less yield. Duration's about 6.5 years. So you're getting about 2 years more duration. And real yields are about 1.5%. So you're getting, on a real basis, about half what you were getting back then. We at Janus Henderson believe that many investors, maybe not all, but many investors, this is not optimal, right? It's too much duration, not enough yield, and definitely not enough real yield. So, what's an investor or asset allocator to do? It's really a conundrum. And the ag just seems very broken and is very frustrating for a lot of investors out there.
No, so given that, right, so the ag, as you mentioned, yielding less, more duration, but at the same time, 60-40 might provide, somewhat of a ballast in terms of risk management. And given the yield curve inversion, we heard from the last session, right, this is the most telegraphed recession ever. What are your current views? Where do you see opportunities within fixed income over the next 6-12 months, areas of interest, but also maybe areas to avoid? But then also, how do you think about the yield curve being inverted, balancing, taking advantage of the front end, but also marrying that with some of that insurance in terms of adding duration in a portfolio?
Yeah, great question. I actually heard 2 things in the last session. The one you mentioned, that the recession is the most forecasted one ever, which I totally agree with. But maybe more importantly, that the fixed income people tend to know a lot more about macro than the equity people. So I'm going to keep that one in my back pocket.
I didn't want to inflate your ego too much. So.
I don't know if that's totally true, but it was nice, I think, Jeremiah said that. So look, most people buy fixed income for one of three things. Sometimes all three, sometimes just one. But the three things are safety, insurance, and income. So safety is usually a cash substitute, right? It's something where it's like an ultra short or short duration income, very high credit quality. You don't necessarily want to put your money in cash or a money market. You want a little bit more yield, but you still don't want to, you want very little to almost no interest rate risk, and you want that safety. Insurance is kind of traditional core. It's longer duration. It's the bedrock of 60-40. And why is that? Normally, when we go into a recession or some kind of dislocation, spreads widen, stocks go down, bonds rally. Obviously, that wasn't the case in 2022, but think back during COVID, right? Rates went way down. And so your high quality fixed income with longer duration or more interest rate risk actually help bail out your equity portfolio. And then income is kind of self-explanatory. You just want that coupon payment that you're getting every month. But normally you have to take some kind of credit risk in order to get a decent amount of income. So what we say here at Janus Henderson is by utilizing our fixed income ETFs, and you combine these things, and let's just, for example, say 60% income, 20% safety, 20% insurance, you can get about 7.5% yield. So that's 2% more than what the ag's giving you. But more importantly, you can get a 3% real yield, right? Inflation right now, it's about mid-4. So 7.5% minus that 4.5% inflation, you're getting a 3% real yield. That's double the real yield the ag's giving you. And less than 4 years of duration. So we think you want some duration, some of that insurance, but probably not optimally as much as the ag is giving you. And even with that, based on the ETFs and this kind of model portfolio, you're only taking slightly more credit risk than the ag. So if you think about that, you're actually doing better than you were 15 years ago. You're getting more yield, more real yield, and less duration. So with ETFs, you can manage and build these portfolios that have less fees and more transparency, and you're getting closer to that efficient frontier, which should get you better incomes in the long run.
And so just on that, and just a quick follow-up in terms of the building blocks for that yield versus duration profile, what sectors in particular are you guys seeing interest in terms of tilting the portfolio to perhaps be more overweight versus underweight?
Yeah, I mean, we like CLOs. We have an ETF that invests solely in high credit quality AAA CLOs, yielding close to 6%, no duration risk because they're floating rate. So again, high yield, very strong credit quality, no interest rate risk. That would go into that safety bucket. We like agency mortgages, which are near all-time wides. Because of some of these bank portfolios coming out. You're getting something like 160, 170 basis points more than treasuries, still high credit quality, but that's where you get some of this insurance, some of this duration, but very high credit quality duration. And then we really like securitized credit. Obviously, talk my book, I spend all my time in securitized, but you're able to get kind of 9% yields without taking a huge amount of credit risk, quite frankly, and not taking much duration. And that's that income component. So I'm combining these three sectors to get that kind of optimized portfolio.
Great. Last question, and hopefully we'll have a minute or two left so we can open up if there's a question from the audience. But we continue to hear a great deal about artificial intelligence these days across many industries, including asset management. Any thoughts around the role of AI and the impact it might have from a broader fixed income universe in the coming years?
Yeah, it's an amazing buzzword right now. AI is definitely coming here to stay. I would say, look, AI is very easy for spoken word or written word because think about it, our language only has 26 letters, and AI is all about looking at, millions of lines of speech or pages and trying to replicate that. In equities, I think it might have more application because there are really only about 4,000 traded equities out there. And normally, a lot of them are fairly liquid. So if you identify an equity you want to buy, you can go out and buy it. But with fixed income, we estimate there are 1 million different fixed income bonds. And this is just the US that you would want to trade at any given time. And you think about the risks of all those bonds. There's duration, there's credit, there's average life, there's optionality, there's liquidity. These risk factors change every day, sometimes intraday, depending on news or economic statistics that come out. So you have 1 million bonds, at least 5 major risk factors that are changing constantly. And not only do you have to price the risk for each bond, but on a portfolio basis, a mean variance portfolio optimization, you have to price the covariance. That's how much each of these bonds move together. So it gets very messy very quickly. But let's just say you could do that. Like AI gets so powerful, computers get so powerful, you could do that. And it spits out 100 bonds that's optimal for your portfolio that it wants you to buy. Doesn't guarantee you can go out there and buy them at any one time. Some you might be able to, but some you might not be able to, and definitely probably not at the price you want to buy it. So it's very tricky in fixed income for these factors I'm mentioning to really get an AI model to work, and that's why I'm getting further on my career, but I'm not really that concerned about computers taking over my job anytime soon. Knock on wood, famous last words.
Excellent. Well, I wanted to thank everyone for their time today. I do see one question. So if we want to just address this in the time that we have left. So John, maybe you had some insight, and we can maybe put this in the world of private credit to be a little more applicable. Do we expect inflows of alternative assets to keep accelerating this year? So I don't know if you have views in terms of what you're seeing from the private credit side. And obviously we're seeing a lot with commercial MBS and potential issues there from the regional bank crisis unfolding. Maybe just some thoughts around that market in general.
Yeah, look, it's all the buzzword. It used to be private equity, now it's private credit. I would agree that most investors out there can have a certain percent of their portfolio in something like private credit. The trade-offs are, right, you should get over time higher yields or higher returns, but there's a massive give up as far as liquidity, transparency, fees. The fees you're going to pay are much higher, and a lot of these funds are structured so you can't get your money out. And we've seen that in commercial real estate, particularly over in Japan with Blackstone, one of the biggest commercial real estate investors in the world. They sold a lot of this private credit over in Asia. And all of a sudden, with all the problems we're getting in commercial real estate, people want their money back and they can't get it. So I would say, look, do your due diligence in that area and realize that you're not going to be able to asset allocate like you can in, particularly in ETFs where they trade daily and you have great transparency of what you're getting and low fees. So I think it's a part of a portfolio, but realize the drawbacks that you're getting into as well.
Excellent. Well, I think we are bumping up against the time, so I will return it back to Sarah, but wanted to thank everyone for their time and attention. Thank you.